buying pressure appeared, and then the sellers tried to overcome that but failed to do so because the fourth candlestick in the pattern fails to advance price to the downside any more than the second candle did. The last candle hits the final nail in the coffin, so to speak, because it opens with a gap up and forms a medium-sized bullish candle. The pattern receives this name because the position of the third candle resembles the shape of a tower. Notice that there is a story that goes along with the pattern, which is that sellers were advancing price to the downside and then started to deaccelerate. After that, a sudden burst of buying pressure appeared, and sellers tried to overcome that. The fact that sellers failed to fully overcome the buying pressure opens the door for the buying pressure to rise and create the bullish reversal pattern. The tower bottom appears when price is going down in order to signal a reversal to the upside. The final complex reversal pattern we are going to see is the tower top, which is the mirror image of the tower bottom, so it's a bearish reversal pattern. The first two candles in the pattern are bullish, one medium-sized candle followed by a small candle. That already denotes a decrease in buying pressure given the decrease in the body size of the second bullish candle. The third candle in the pattern is a small bearish candle that opens with a gap down. That means a sudden burst of selling pressure. The fourth candle in the pattern is equal to the second candle in the pattern, and it opens with a small gap up. The important thing here is that a sudden burst of selling pressure appeared, and then the buyers tried to overcome that but failed to do so because the fourth candlestick in the pattern fails to advance price to the upside any more than the second candle did. The last candle hits the final nail in the coffin, so to speak, because it opens with a gap down and forms a medium-sized bearish candle. Observe that there is a story that goes along with the pattern, which is that buyers were advancing price to the upside and then started to deaccelerate. After that, a sudden burst of selling pressure appeared, and buyers tried to overcome that. The fact that buyers failed to fully overcome the selling pressure opens the door for the selling pressure to increase and create a bearish reversal pattern. The tower top appears when price is going up in order to signal a reversal to the downside. We want to move on now to the continuation patterns. In other words, the candlestick patterns that imply that price will continue to go in its current direction. A couple of things to notice here before we dive into the patterns is that there aren't as many continuation patterns as there are reversal patterns, and there aren't simple continuation patterns. We'll start with the complex continuation patterns formed by two candles. The first complex continuation pattern we are going to study is the bullish separating line, which is formed by one medium-sized bearish candle followed by one medium-sized bullish candle that opens with a gap as big as the body of the first bearish candle. The logical interpretation here is very simple. Since the second candle opens with a large gap up and it creates a medium-sized bullish candle, it becomes clear that there is a considerable amount of buying pressure implied in this pattern. The bullish separating line appears when price is going up in order to signal a continuation to the upside. Next, we have the bearish separating line, which is the mirror image of the bullish separating line, so it's a bearish continuation pattern. The pattern is formed by a medium-sized bullish candle followed by a medium-sized bearish candle that opens with a gap as large as the body of the first candle. The fact that price opens in the second candle with a large gap down, added to the fact that the second candle has a bearish quality, implies that there is a lot of selling pressure in the market. The bearish separating line will appear when price is going down in order to signal a continuation to the downside. The next pattern is the bullish on-neck line, which is also composed by two candles. The first is a medium-sized bullish candle. The second is a small bearish candle that opens with a considerable gap up. The logical interpretation here is that the fact that the second candle opened with a gap up and was unable to close this gap implies that there is a lot of buying pressure in the market and sellers are not strong enough to fill the gap, which implies that price will continue to go up. The bullish on-neck line appears when price is going up in order to signal a continuation to the upside. Next, we have the bearish on-neck line, which is the mirror image of the bullish on-neck line. So it's a bearish continuation pattern composed by two candles in the formation. The first candle is a medium-sized bearish candle, and the second is a small bullish candle that opens with a considerable gap down. The fact that the second candle opened with a gap down and was unable to fill that gap implies a strong selling pressure in the market, and therefore price tends to continue going down. The bearish on-neck line appears when the price is going down in order to signal a continuation to the downside. This covers the complex continuation patterns formed by two candles. Next, we are going to study the complex continuation patterns formed by three candlesticks. The first complex continuation pattern formed by three candlesticks is called upside Tesuki gap, which is a bullish continuation pattern similar to the bullish on-neck line, but with a few extra details. The first candlestick in the pattern is a medium-sized bullish candle. The second candle in the pattern is a small bullish candle that opens with a gap up, and the third candle is a small bearish candle that fails to close the gap created between the first and second candlesticks in the pattern. It's clear that there is a lot of buying pressure between the first and second candlesticks. The third candle in the pattern adds more confirmation to the buying pressure because it fails to close the gap created by the first two candles in the pattern. In fact, it doesn't even attempt to close the gap. The bullish Tesuki gap appears when price is going up in order to signal a continuation to the upside. Next, we have the downside Tesuki gap, which is the mirror image of the upside Tesuki gap. So it's a complex bearish continuation pattern. The first candle is a medium-sized bearish candle. The second is a small bearish candle that opens with a gap down. And the third is a small bullish candle that fails to even attempt closing the gap created between the first and second candlesticks in the pattern. It's clear that such a pattern implies a lot of selling pressure because of this failure to close the gap down. The downside Tesuki gap appears when the price is going down in order to signal a continuation to the downside. Next, we are going to see the complex continuation patterns formed by four candlesticks in the pattern. The first one is called bullish three-line strike, which is formed by three consecutive small to medium-sized bullish candlesticks, followed by one large bearish candlestick that closes more or less where the first candle in the pattern opened. The logic behind this pattern relates to the idea of quick exhaustion of selling pressure. Notice that price rises slowly and then all the selling pressure that was also building up is exhausted all at once. This opens headroom for buying pressure to continue. This can seem a little counterintuitive at first because of the size of the bearish candle and the fact that this is a bullish continuation, but the key is to understand this concept of quick exhaustion of selling pressure in this particular case. The bullish three-line strike happens when the price is going up in order to signal a continuation to the upside. Next, we have the bearish three-line strike, which is the mirror image of the bullish three-line strike. So it's a bearish